The BSE and NSE. Most of the trading in the Indian stock market takes place on its two stock exchanges, the Bombay Stock Exchange (BSE) and the National Stock Exchange (NSE). The BSE has been in existence since 1875. The NSE, on the other hand, was founded in 1992 and started trading in 1994. However, both exchanges follow the same trading mechanism, trading hours, and settlement process. Bombay Stock Exchange is the biggest stock exchange in the world. There are about 5,000 listed companies on the BSE, while NSE has more than 1,600 companies listed on its platform, while there are many common stocks between the two bourses. The National Stock Exchange (NSE) set its total futures and options (F&O) turnover scaled a record high of ₹5 32,612 crore today, surpassing the previous high of 441,534.45 crore rupees that it had touched on July 10, 2014. Bank Nifty turnover as a subset of total equity derivative turnover on the exchange MRF has the highest share price in India among all the listed companies on BSE, NSE. The all-time high share price of MRF is 81,426 rupees. Nifty 50, Nifty is the abbreviation of National Stock Exchange 50. It is the benchmark index of NSE comprising 50 stocks. Sensex is the benchmark index of BSE and it is derived from the words sensitive and index. Sensex comprises of 30 stocks. Sensex and Nifty are the face of the Indian stock market as these either go up or down depending on various political and economic factors. Who can invest in India? India started permitting outside investments only in the 1990s. Foreign investments are classified into two categories, foreign direct investment (FDI) and foreign portfolio investment (FPI). All investments in which an investor takes part in the day-to-day management and operations of the company are treated as FDI, whereas investments in shares without any control over management and operations are treated as FPI. For making portfolio investments in India, one should be registered either as a foreign institutional investor (FII) or as one of the sub-accounts of one of the registered FIIs. Both registrations are granted by the market regulator, SEBI. With the initiation of new economic policy in 1991 and subsequent reforms process, India has witnessed a change in the flow and direction of foreign direct investment (FDI) into the country. This is mainly due to the removal of restrictive and regulated practices. Foreign direct investment in India increased from US $129 million in 1991-92 to US $40,885 million in March 2005, an increase of about 316.9 times. However, the country is far behind in comparison to some of the developing countries like China. Insofar as growth trend of FDI is concerned, there has been quite impressive growth of FDI inflow into the country during this period. However, negative growth rate is noticed during the period 1998 to 2000 primarily due to falling share of major investor countries, steep fall of approval by 55.7% in 1998 compared to 1997 and slackening of fresh equity. However, traditional industrial sectors like food processing industries, textiles, etc., which were once important sectors attracting larger FDI, have given way to modern industrial sectors like electronics and electrical equipments, etc. In this paper, analysis on the factors affecting potentiality and challenges of FDI in the country is discussed and open a room for future discussion. Foreign direct investment (FDI) in India is a major monetary source for economic development in India. Foreign companies invest directly in fast-growing private Indian businesses to take benefits of cheaper wages and changing business environment of India. Economic liberalization started in India in wake of the 1991 economic crisis, and since then FDI has steadily increased in India, which subsequently generated more than 1 crore 10 million jobs. According to the Financial Times, in 2015 India overtook China and the United States as the top destination for the foreign direct investment. In first half of the 2015, India attracted investment of $31 billion compared to $28 billion and $27 billion of China and the US respectively. On 17 April 2020, India changed its Foreign Direct Investment (FDI) policy to protect Indian companies from opportunistic takeovers, acquisitions of Indian companies due to the current 2019-20 coronavirus pandemic. According to the Department for Promotion of Industry and Internal Trade, while the new FDI policy does not restrict markets, the policy ensures that all FDI will now be under scrutiny of the Ministry of Commerce and Industry. There are two routes by which India gets FDI. 1. Automatic route. By this route FDI is allowed without prior approval by government or Reserve Bank of India. 2. Government route. Prior approval by government is needed via this route. The application needs to be made through Foreign Investment Facilitation Portal, which will facilitate single window clearance of FDI application under approval route. The application will be forwarded to the respective ministries which will act on the application as per the standard operating procedure. The stock market of India is expected to return 18.6% a year for the coming years. This is from the contribution of economic growth in local current prices, 11.52%, dividend yield, 1.33% and valuation reverse to the mean 5.79%. This is the projected return of the stock market in India relative to other countries. Big bull Rakesh Jhanjhanwala sees the Nifty touching 125,000 by 2030, considering the fact that company or corporate earnings are expected to grow by 16% annually. The target is almost 13 times the index's close of 8,564.40 on Thursday. Jhanjhanwala told a news channel that the Nifty has grown 10 times in the last 15 years and can jump 10 to 12 times in the next decade. So, based on the assumption of strong economic growth, bounce back in corporate earnings to double digits and revival in investment cycle, the Nifty and the Sensex can reach these levels, which look more like a tall task. When asked about the targets are they working with for the next 15 years, most of analysts agreed that the bull run is here to stay, but said there are caveats and assumptions which needs to get fulfilled first before we can achieve these targets. Most global brokerage firms have expressed their confidence in the India's story with Narendra Modi at the helm of things. This is reflected in their overweight stance on the India markets, which have outperformed global markets in the year. The Indian markets are still trading below previous valuation peaks of 25x, which also supports the optimism.